Today, we're going to synthesize a remarkably data-dense global economic landscape. Now, if you've been following the markets at all lately, you already know we're heading into an absolutely critical week-ahead brief scenario. We really need to unpack exactly why interest rate cuts have basically stalled out across the globe and zero in on precisely what you should be watching in the highly volatile week ahead. Basically, we're looking at a massive collision between geopolitics and sticky inflation, and the ripple effects? Well, they're reshaping portfolios everywhere. We've got a ton of ground to cover across multiple continents, so here is our roadmap for today. 1. The global macro conflict. 2. Recent central bank moves. 3. The Fed's hawkish hold. 4. The global week ahead. And 5. The new monetary reality. Alright, starting right off with Section 1, the global macro conflict, a sudden energy shock. $100, that is a staggering figure, and it represents the surge in Brent crude oil, which is pricing right back above $100 a barrel. This is being driven directly by renewed escalations in tensions between the United States and Iran in the Middle East. And the reason this matters so much for us is that this sudden energy shock is acting as the primary catalyst, complicating our disinflationary progress globally. You know, central banks were just starting to see a little light at the end of the tunnel, and then suddenly, bam, rising input costs and supply chain frictions are right back on the table. And that energy shock is colliding head-on with something called sticky core inflation. Think of sticky core inflation as those really stubborn, persistent price increases in underlying services and goods that just won't budge. Even before this massive oil spike, core inflation was already being propped up by incredibly resilient service sectors, some major structural shifts in technology trade, and elevated public sector wage growth. So when you drop a massive, primary energy shock right on top of that already sticky core inflation, policymakers get very, very nervous. So how are they reacting? That brings us to Section 2, recent central bank moves and their ripple effects. Over just the last week, the sheer contrast in the global data has been wild. On one hand, you have rapid-fire holds. The PBOC in China kept their one-year loan prime rate at 3%, and the ECB in the Eurozone is holding steady, strictly leaning on a data-dependent stance. But then, we get hit with these massive data surprises. New Zealand just posted an inflation surge to 4.1% year-over-year, literally their highest in 2.5 years. Australia shocked pretty much everyone with a massive labour market surge, adding over 76,000 jobs in June when expectations were sitting way down at 15,000. And over in the UK, core inflation is holding stubbornly steady at 2.6%. Honestly, these massive data surprises are completely upending the whole narrative that we were heading into a period of prolonged monetary easing. And the market is reacting violently. Institutional investors are pivoting fast because these sticky prices and hot labor markets prove that central banks simply can't afford to sound dovish yet. Money markets are actively unwinding their easing expectations, and instead, they're pricing in a prolonged plateau of elevated global interest rates. That era of imminent aggressive rate cuts we all thought was coming? Yeah, that's completely on ice for now. Which tees up Section 3 perfectly, the Fed's hawkish hold and Chair Warsh's balancing act. Wednesday is a massive focal point for global financial markets. The Federal Open Market Committee is widely expected to maintain their target range at 3.50 to 3.75%. This is what we call a textbook hawkish hold. They're leaving rates unchanged for now, but heavily communicating that they are totally ready to resume hiking if they need to. See, a softer June CPI gave them a tiny bit of operational flexibility to pause, but they're using this hold to really evaluate the economic fallout from this new Middle East energy shock. And honestly, looking at the underlying pressures, there is zero chance the Fed sounds dovish on Wednesday. Core inflation is still noticeably above target. Plus, we're seeing memory semiconductor costs starting to push consumer electronics prices higher, and we have the expiration of Section 122 universal trade tariffs hitting this week. Because of all this, officials like Waller and Cook have actually expressed willingness for more tightening, while Logan, Hammark, and Koshgari are totally open to acting sooner rather than later. Analysts are actually flagging the potential for 2 to 4 formal dissents. Chair Kevin Warsh is going to be navigating a deeply divided committee. Alright, let's look forward with Section 4, the global week ahead, which is shaping up to be the ultimate policy test. Buckle up, because this is one of the most action-packed economic calendars we have seen all year. We're bouncing from Washington and the Bank of Canada minutes on Wednesday straight into huge Bank of England and Bank of Japan decisions on Thursday, and rounding it all out with critical inflation and PMI data from Tokyo, Europe, and China on Friday. if you want to know where the global economy is going, this is the week you absolutely must pay attention to. Kicking things off on Wednesday, we've got Australia's quarterly consumer price index. Now, quarter-over-quarter headline inflation is projected to drop from 1.4 down to 0.7%. But don't let that fool you. The core trimmed mean, which is the metric the Reserve Bank of Australia actually cares about, is forecast to rise to 3.7%. Middle East trade disruptions are already wreaking havoc on their domestic housing and food service categories. Shifting gears to Thursday. The baseline expectation for the Bank of England is to hold rates steady. But the real story here is the internal committee dynamic. Keep a very, very close eye on committee member Catherine Mann. Because of those elevated energy costs and that resilient core inflation we just talked about, she's viewed as a highly likely candidate to push for an immediate rate hike. We could realistically see a very hawkish shift from their previous 7-2 voting split. Also, on Thursday, the US drops advanced second quarter GDP. And the Atlanta Fed's GDP Now tracker, it's estimating that growth is decelerating pretty heavily, dropping from 2.1% in Q1 to an estimated 1.7% in Q2. So why the slowdown? Widening trade deficits. The US is importing a massive amount of capital goods to build out artificial intelligence infrastructure, while industrial exports are weakening. Oh, and by the way, this GDP print is going to hit the tape right alongside the crucial June PCE inflation data. Closing out our Thursday central bank marathon, the Bank of Japan is nearly a lock to hold their rate at 1%. Markets are pricing in a 96% probability of a hold following their recent hike. But the actual event to watch here is their quarterly outlook report. Markets are going to dissect those median projections to see if this explosive global AI demand, which is really propping up Japanese industrial exports, forces an upward revision to their 2026 real growth projections by maybe 0.5%. So, bringing all of this together, let's move to Section 5, the new monetary reality and navigating the tightrope. Central bankers today are performing a dangerous, monumental tightrope walk between two totally competing forces. On one hand, they have to weigh a very noticeable deceleration in headline economic momentum and real growth, but on the other hand, they are actively fighting renewed upward price shocks and secondary inflationary spillovers from energy, freight, and technology supply chains. It's an incredibly difficult balancing act, and one misstep could either trigger a full-blown recession or allow inflation to become permanently unanchored. Which brings us to the most critical takeaway of this entire expliger. As you watch this crazy wave of central bank decisions and economic data roll in this week, this is the ultimate question you have to ask yourself regarding the future of your portfolio. Are current policy settings sufficiently restrictive as they are, or is a secondary round of global monetary tightening completely inevitable before the end of the year? Think about that as the week unfolds. Thanks for joining me, and stay sharp out there.